Hello, and welcome to another stock analysis on Stock Market Palantir. Don't forget to subscribe and drop your comments. Now, let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about HWH International Inc. or HWH.
HWH, yes. This is a stock that, truly encapsulates the wild, sometimes baffling dynamics of the controlled microcap space. We are looking at a company with annual revenues barely clearing, $1.1 million, all while sustaining a massive net loss. The profit margin is somewhere around negative 91%.
And that disconnect, that immense gap between its happy marketplace business model and the abysmal financial reality is precisely why we're looking at it. This company's valuation is clearly not tethered to its balance sheet at all. Instead, we're here because of a pretty significant technical event that just happened.
Right. In early December 2025, the stock just had this sudden, explosive surge. On one particular day, the price shot up to the $2.40 level, posting an abrupt 31% gain in the after-hour session. A move like that, especially outside of normal trading hours, it forces you to look past simple speculation.
Absolutely. So we really need to analyze the forces driving this. Is HWH's market behavior primarily a function of its engineered structural market mechanics, the extremely low public float, the heavy short interest, the opaque dark pool action, or is the price action being dictated by the intentional active corporate maneuvering of its highly concentrated ownership?
And I'll be arguing that while the structure is a crucial ingredient, the intentional corporate maneuvers and, frankly, the governance decisions by leadership are the primary controlling factors. They're actively using those mechanics as a lever for their own objectives.
And I'm going to make the case that the underlying structural fragility is the dominant force here. HWH, by its very design, is less of a traditional company and more of a tightly wound trading vehicle where price is dictated by extreme supply scarcity colliding with some very powerful and predictable technical factors.
Well, let's start with that scarcity, because that's the undeniable foundation of this entire situation. The CEO, Chan-Heng Fai, he controls roughly, 78.4% of all outstanding shares.
And just to put that into perspective for everyone, that means the public float, the shares actually available for trading, is less than 22%. In the world of microcaps, that is almost textbook engineered scarcity.
I agree. The low public float is a critical enabling factor.
I'd say it's more than enabling, it's causative. That extreme scarcity ensures that, relatively low volumes of buying or selling can trigger these rapid, outsized price moves like the 31% surge we're talking about. This structure isn't passive. It's a vulnerability that gets actively exploited by technical dynamics. And the data confirms this. Leading up to that spike, the cost to borrow shares for short selling was astronomically high, consistently ranging between 71 and 87%.
And that high cost to borrow, which is the premium shorts pay, is certainly prohibitive.
Exactly. And when you combine that with the high off-exchange short volume ratios, often well over 50%, it hit almost 68% the day before the surge. It just confirms that classic short squeeze mechanics are not just influencing the price. They are the primary driver of this volatility. The price is reacting violently to forced technical covering in a market that simply has no supply.
That's an interesting point, though. How would frame it a little differently? I see that structure as just a consequence, a tool that management uses to their advantage. Their actions determine the trajectory. So yes, the structure provides the fragility, but I think management provides the directional force.
Okay, so what specifically, beyond just general governance, points to management action as the direct cause of that 31% spike?
The catalyst for that move to 240 was the Form 8K disclosure. For our listeners who may not track these daily, an 8K is a filing for major events shareholders need to know about. And this particular filing revealed the November 26 award of 1 million restricted shares directly to the CEO.
I accept that the filing occurred, sure.
But the market, both the trading algorithms and retail sentiment, they interpreted that massive share grant as a strong signal of insider accumulation.
Of conviction.
So you have to ask yourself, why would a compensation package cause such a huge move if the corporate strategy, if management signal wasn't the dominant factor here? The news provided the incentive for the structure to move.
I'll concede the news provided the incentive, but without the structural tightness, that incentive is negligible. The insider filing was the spark, yes, but the flame, that exaggerated 31% jump, was purely a result of the high cost to borrow and trapped short sellers scrambling to cover. That's just market mechanics. If HWH had a 50% float, the same news might cause, what, a 5 or 10% move, not a 1/3 spike in value.
I'm not convinced because you're treating the float as an accident. I see this persistent volatility as a calculated management tool. We have a history here. Chan Hengfi made substantial open market purchases back in 2024, buying over 5.7 million shares. This is not accidental. It shows a strategic goal to restrict the float even further.
I see the control, but why restrict the float if not just to turn it into a high beta trading vehicle?
For corporate survival, the company has to maintain access to capital through speculative interest because it can't generate it through operations. I mean, how do you raise money when your core business is hemorrhaging cash? You engineer a structure that attracts exactly this kind of speculative capital, which lets management do offerings later on. It's active management, driven by the need to offset that awful profit margin.
But let's look at where price discovery actually happens. The microstructure data shows off-exchange trading, dark pool activity, frequently making up over 50% of the volume. And when we talk about dark pools, we're really talking about private exchanges where big blocks are traded away from the public eye. This kind of fragmentation inherently creates wilder, less rational swings when volume picks up. It completely divorces the price from the corporate narrative, whether that's the all-set marketplace or the CEO's maneuvering. The volatility is a function of opaque execution.
That's a compelling point on execution, but I think we have to prioritize the strategic context over the technical medium. I'm just not convinced that market mechanics should take precedence over the context of the all-set ecosystem. HHF is clearly not a standalone company. It's a node, one piece of a broader controlled web under Chan Hengfi.
The related party transactions do raise red flags about that ecosystem. I agree with you there.
Exactly. We see it all the time, like the September 2025 sale of 70% of Alset FNB1 to a related party for a pretty modest sum. These actions strategically alter the company's profile. So the central question becomes, are these decisions being made to benefit HWH shareholders or to optimize the broader Alset holding structure? This focus on financial engineering just screams corporate control.
I see why you emphasize those deals, but they mostly just confirm the company's low fundamental value. They're a consequence of poor performance, not the cause of sudden extreme volatility. What causes the volatility is the regulatory tightrope HWH has to walk, epitomized by that 1-for-5 reverse stock split back in February 2025.
You call it a tightrope walk. I call it aggressive corporate architecture.
It was a compliance maneuver, pure and simple. It was necessary to avoid NASDAQ delisting after the share price fell below the $1 minimum. This constant battle just to maintain their exchange listing confirms the inherent structural fragility of the vehicle itself. Management is reacting to the structure failing, not actively dictating market moves.
The reverse split is precisely the kind of intentional maneuver I'm talking about, though. It's an aggressive corporate decision that fundamentally changes the share count simply to maintain listing status. We see this elsewhere in the ecosystem. Alsec Inc. also had a big reverse split. Management's priority is keeping the public listing viable so they can continue to control a public entity, regardless of its operational success. They are manipulating the architecture to keep the trading vehicle alive.
But let's look at the ultimate market mechanism failure point, fails to deliver, or FTDs. This is a technical market structure issue that goes beyond any single corporate announcement. And for listeners, FTDs are when a seller fails to deliver shares to a buyer by the settlement date.
An often cited signal of significant market friction. Sure.
Precisely. The persistent pattern of FTDs in HWH,
spiking massively. We saw over 500,000 shares failed to deliver in September 2025. It indicates huge settlement frictions and, the strong potential for unchecked naked shorting. This technical inability to deliver shares is a pure market structure phenomenon. It creates what people call a coiled spring for upward moves, totally independent of what the CEO files on an 8K. The stock is just a technical anomaly waiting for a trigger.
I agree that the FTDs are leveraged by traders and it confirms the scarcity. But let's talk about the result of the structure. The corporate maneuvers, like that $1.76 million public offering in early 2025, show that the company has to continually use its public structure to raise cash to offset those massive operational losses.
That's the utility of the structure, yes.
But the need for capital is the foundational instability, not just the trading mechanics. Management aggressively maintains the public shell through splits, reincorporating to Nevada to limit their liability, timed announcements, specifically so they can use it as a capital-raising machine. The volatility attracts the exact kind of speculative investor they need for these offerings. So the financial engineering, which is driven by corporate intent and desperation, is the dominant factor here.
And that financial engineering is successful only because the structural mechanism lets the stock price float high enough to make those offerings viable. If the high cost to borrow wasn't there, if the float wasn't so restricted, if dark pool fragmentation didn't exist to amplify swings, the whole thing collapses. The volatility is the mechanism, and the mechanism is structural.
And without the aggressive strategic corporate maneuvers, the share awards that signal commitment, the Nevada move that reinforces control, the structural fragility is just a thin float. It doesn't have the directed force required to sustain a multi-million-dollar market cap for a deeply unprofitable company. Management provides the direction, the structure provides the horsepower.
Price action is overwhelmingly dictated by extreme scarcity, which management may enforce, but which the market then exploits through pure technical pressure. The low float, high cost to borrow, and fragmented price discovery, it all turns this into a high beta transactional instrument. The focus for anyone trading this has to be on the microstructure data, not the business.
While I accept that the mechanics present a clear danger to shorts and amplify news, I believe the trajectory is ultimately controlled by management strategic decisions. The history of related party deals, the shift in Nevada for liability protection, the timing of stock awards. It all shows that the company is actively managed within the asset ecosystem to maintain compliance and facilitate capital flows, using that low float as their most effective lever. To truly assess the risk, you have to understand its corporate genealogy and strategic intent first.
It seems clear that in this unique asset class, this controlled microcap space, the line between engineered structural volatility and strategic corporate maneuvering is exceptionally thin. It requires constant vigilance from the market to even try to discern whether you're watching motive or mechanism at any given time.
Indeed, it's a structure that rewards continuous skeptical analysis over simple fundamental belief.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.